In this video we will analyze Divi's Laboratories. Start with the business of Divi's Laboratories. Our primary goal is to encourage individual investors to make informed decisions and pay reasonable prices so that we can minimize the risk of losses and maximize potential gains. Divi's Laboratories is a leading Indian manufacturer of active pharmaceutical ingredients, APIs, and intermediates, supplying to the global pharmaceutical industry. It is one among the top 3 API manufacturers in the world and one among the top API companies in Hyderabad. APIs produced by Divi's Laboratories are used as raw materials by other manufacturers to create finished pharmaceutical products such as tablets, capsules, and injections. The company has a vertically integrated business model, which includes in-house research and development, manufacturing, and distribution capabilities. Divi's Laboratories produces a range of high-quality APIs and intermediates, including those used in drugs for cardiovascular, central nervous system, and anti-inflammatory diseases. Divi's Laboratories generated approximately 85% of its revenue from exports. The company has a diverse customer base in North America, Europe, and Asia and exports its products to more than 100 countries around the world. The United States is one of the company's largest markets, accounting for a significant portion of its export revenue. Now understand the competitive advantages that help it maintain its market position and generate sustainable profits over the years. Divi's Laboratories specializes in complex chemistry, which is a highly technical and difficult field. The company has developed significant expertise in this area, which allows it to produce high-quality APIs and intermediates that meet the stringent regulatory requirements of the pharmaceutical industry. The company has a strong focus on cost efficiency and has invested in technology and automation to reduce its production costs. This allows Divi's Laboratories to offer its products at competitive prices while still maintaining healthy profit margins. The company has a diversified customer base, which helps it to mitigate the risk of dependence on a few large customers. Divi's Laboratories serves a range of customers across different geographies, which provides stability and resilience to its revenue streams. Divi's Laboratories invests heavily in research and development to develop new products and improve its existing offerings. The company has a dedicated R&D team that works on developing new processes and technologies to enhance the efficiency and quality of its products. Divi's Laboratories has a strong regulatory compliance record and adheres to the highest quality and safety standards in the industry. This is critical in the pharmaceutical industry, which has stringent regulatory requirements and helps the company to maintain its reputation and customer trust. Now let's look at the management, the key people who are vital for business success. It sets goals, plans resources, motivates employees, and makes strategic decisions for growth and profitability. Dr. Murli K. Divi. Dr. Divi is the founder and managing director of Divi's Laboratories, leading the company's technical and financial operations. With over 15 years of experience in pharma, he holds a PhD in pharmaceutical sciences and is a member of the American Institute of Chemical Engineers and the American Chemical Society. Mr. N.V. Ramana. Mr. Ramana, Executive Director of Divi's Laboratories, has 25 years of experience overseeing strategic planning, sales, marketing, custom manufacturing, contract research, and nutraceutical ingredient development. He previously enhanced business development for several pharma companies and holds a chemistry degree from Osmania University. He is also a member of the American Chemical Society. Now we will analyze the company on the basis of 6 key financial data so that we pay the bargain price to achieve without any emotional bias. The 6 key numbers are debt-to-equity ratio, return on equity, sales growth, profit growth, equity growth, cash growth, operating cash and free cash. Debt-to-equity ratio as it measures the company's level of leverage and risk associated with its financing structure. Lower debt-to-equity ratio is considered better as it indicates lower financial risk and greater solvency. Return on equity is important as it measures the profitability of a company's shareholder investments. Sales growth and profit growth are crucial for business expansion and sustainability. Equity growth reflects a company's ability to generate profits for reinvestment, while cash growth, operating and free, indicates its ability to fund operations and invest in growth. Operating cash flow is the cash generated from a company's normal business activities. Free cash flow is the cash remaining after a company has paid its expenses and investments. In this spreadsheet, we can see the year-on-year growth for the last 10 years and consider the median return and growth rate to calculate the future growth because using the median value of 10 years of year-on-year growth provides a more reliable measure of long-term performance. For Divi's lab, the median values are as follows. Debt-to-equity ratio is almost zero. Return on equity 22.7%, which is good. Year-on-year. Sales growth 18%. Equity growth 17.9%. Profit growth 12.9%. Operating cash growth 24.3%. Free cash growth 16.3%. Operating cash growth and free cash growth are almost consistent with profit and sales growth. It indicates that the company is generating sustainable cash flows. We will calculate the future price on the basis of three parameters: sales growth, equity growth, and profit growth. Our goal is to buy a good business at a reasonable price so that we can generate minimum return on investment 15% per year, which makes our money double approximately after 5 years. First, we calculate market capitalization to sales ratio. The market capitalization to sales ratio is an important tool to measure a company's market value in relation to its annual sales. Trailing 12 months sales is 8,335 crore. Historical sales growth is the median of 10 year-on-year growth 18%. Historical 10 years median market cap to sales ratio is 9.3. Available on screener.in. Face value per share is rupees 2. We get the number of outstanding shares. Now our forecasted sales after 5 years is 19,068 crore. Our default market cap to sales ratio is 2. That means we are ready to pay double the sales number. Now we take the minimum of historical and default market cap to sales ratio to forecast the market cap to sales ratio after 5 years. Now the forecasted market cap after 5 years is equal to market cap to sales ratio after 5 years multiplied by forecasted sales after 5 years. Now the forecasted price per share after 5 years is the forecasted market cap after 5 years divided by numbers of outstanding shares. So the present fair price per share is the forecasted price per share after 5 years divided by 2. As per our minimum expected return on investment 15% per year and makes our money double after 5 years. So according to the capitalization to sales ratio of Divi's lab, the present fair price for us is 720. Now we calculate the fair price for us on the basis of price to book value ratio. The price to book value ratio is an important tool to measure a company's market value in relation to its book value or shareholder equity. Take the trailing 12 months book value per share is 458.0, available on screener.in. Historical book value growth is the median of 10 year-on-year equity growth 17.9%. Historical 10 years median price to book value ratio 7.0. Now our forecasted book value per share after 5 years is 1043. Our default price to book value ratio is 2. That means we are ready to pay double the price of book value per share. Now we take the minimum of historical and default price to book value ratio to forecast price to book value ratio after 5 years. Forecasted price after 5 years is the forecasted book value per share after 5 years multiplied by forecast price to book value ratio after 5 years. So the present fair price per share is the forecasted price per share after 5 years divided by 2. So according to the price to book value ratio of Divi's lab, the present fair price for us is 1043. Now we calculate the fair price for us on the basis of price to earning ratio. The price-to-earning ratio is another important tool to measure a company's market value in relation to its earning per share and its growth. Trailing 12 months earning per share is 90.3. Historical earning per share growth is the median of 10-year-on-year profit growth 12.9%. Historical 10 years median price-to-earning ratio is 31.7. Now our forecasted earning per share after 5 years is 165.6. Our default price-to-earning ratio is double the profit growth, median profit growth for last 10 years multiplied by 2, that means we are ready to pay double the price of profit growth. Now we take the minimum of historical and default price-to-earning ratio to forecast price-to-earning ratio after 5 years. Forecasted price after 5 years is the forecasted earning per share after 5 years multiplied by forecasted price-to-earning ratio after 5 years. And again the present fair price per share is the forecasted price per share after 5 years divided by 2. So according to the price-to-earning ratio of the Divi's lab, the present fair price for us is 2136. Now we get 3 different price according to 3 different parameters. Average the 3 prices gives us a conservative fair price of 1300. Now most importantly we need margin of safety. The margin of safety minimizes losses in case of mistake. So the buy price would be below 1300. If we want to buy with 50% margin of safety, the bargain price is 650. If you find the video is useful, please subscribe to our channel.